Our next speaker, I've been informed, is the go-to person for everything you want to know on buying and selling companies across Europe. Enrique Pérez Hernández is the managing director at Morgan Stanley & Co. in London. For the past 20 years, he's been the head of EMEA Technology and Investment Banking at Morgan Stanley. And the rest, I will leave in his hands to tell you. Thank you so much, Enrique. Welcome.
Thank you. Okay. Just let people settle in.
Creo que sí. Sí. Ahora sí.
So, good afternoon, everyone. Thanks for joining me here today. It's a pleasure to be here. Thank you for all the organizers putting this event together. As a Spaniard, I can tell you, living in the technology world, seeing this sort of event here in Spain is very exciting. As per my introduction, I work for Morgan Stanley. I'm a managing director based in London. I run our tech team in Europe. And basically, I spend my day working in helping companies either raise capital and or assess M&A opportunities. So I thought I'd share over the next 25 minutes what we've been seeing happening across capital markets and M&A, which I would like to think is relevant for the audience as far as you're thinking eventually about raising capital at a later stage in your growth phase, and importantly, eventually about monetization, whether it's by looking for new partners, new shareholders, and or taking the business public. I want to start by talking a little bit about what's been going on from an equity capital markets perspective, particularly on the public side, which is a big driver of what happens also in the M&A side. We've seen a phase of significant growth in IPO volumes around technology companies for the last 4 or 5 years. That hit its peak in 2014, and you can see from the chart it really slowed down very significantly in 15 and particularly in 16. To give you an idea, typically we see about 50 IPOs globally in the tech space. This year, up until the summer, we had 7. It is true the environment is re-accelerating post-summer, and notwithstanding the US elections, which are going to clearly weigh on investors' minds as they think about the IPO product, we're hopefully going to be seeing a few more IPOs hitting the market before year end. I think we will be seeing this acceleration much more strongly going into next year. The level of activity very much dominated by internet and software stocks for most part, which have typically been the ones who've been growing the fastest. Now, what is quite interesting is when you look at the tech space, and there's about 250 companies that have gone public over the last 15 years. If you pick the top 30 in terms of value creation, 6 of them accumulate 63% of the value creation. It is an incredibly concentrated picture in terms of how value creation has developed. And not surprising to you, it's all the big names you would think of. It's the likes of Google, Facebook, or some of the Chinese players that are coming through, such as Alibaba. So very, very concentrated. We'll see later that the same level of value concentration has played out in the private markets as well. Now, what has happened, trying to understand why this deceleration in levels of activity and how we think about what's driving future IPOs, the performance from around 13, where it peaked in multiple terms, has come down quite significantly into 14 and 15. This chart just shows over time, using a revenue multiple as a proxy. Not all companies can be valued on profitability metrics because they may not be profitable at IPO. You see how the return after IPO has come down over time. That's very important in terms of how investors think about the IPO product, because they're all looking for returns. And those returns have come down quite dramatically all the way to 15. That really drove a big deceleration in the IPO product. Basically, it drove an increased amount of volatility and investors taking a step back in terms of how forceful they were and creative or constructive in looking at valuations. 16 is playing out a little bit better. I think there's been a readjustment. You will remember in January, February, there was a big adjustment in the markets, particularly around technology and internet stocks and software stocks, 30% was probably the average adjustment you saw in multiples. That has allowed for a bit of a resetting in valuation expectations. And in 2016, we've seen better performance. When you look at that in terms of how it's played out over the last 18 months, we're now starting to see again majority of the IPOs that have gone public being above the issue price. That is a critical point of reference because the IPO product generally is perceived to be as a high-risk product by equity investors in the public markets. And therefore, their willingness to play is very much driven also by the recent track record of how the product is performing from a returns perspective. And all but one of the IPOs that have been priced year to date in 16 actually are above IPO price, which should provide for a very good footing going into 17. To my earlier comment around absolute valuations, during 2012, 13, 14, 15, you saw a relatively stable range, companies being IPO'd somewhere between 2.5 and 5.5 times revenue. Now, every company is different, the profitability profiles differ, so that's going to influence how investors think about value. But you see a sharp reduction in valuation levels, particularly at the high end of the range in 16. And that is really a reflection of the correction I referred to before at the beginning of the year, which is now really stabilized. And that has been one of the main drivers why the activity levels in IPOs has come down. Issuers basically have had to readjust their expectations around valuation levels. What drives in investors' minds valuation? What drives a premium valuation? Up until 2-3 years ago, it was all about growth. It was all about top-line growth, top-line growth, top-line growth. The usual debate we would have with our clients is, what do we do? Do we drive profitability or do we reinvest all our profitability into growth? And by and large, the market was telling you, grow, 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 we're going to pay you top dollar for your growth. That has really changed. What this chart shows is the highest correlation between the highest valuation multiples comes with the right combination of growth and profitability. It is incredibly challenging to take a company public in this market which is not profitable or at least break even in the next 12 months at the point of IPO. And you need to have real visibility. So I think as some of you here, you're growing your businesses, do always try to remember that keeping that balance between growth and profitability, particularly at the time you start approaching monetization, whether it's through an IPO or a trade sale, is particularly important. Now, that stagnation of the IPO market has had one result, which is the private market has grown to a very significant scale. And in fact, you could almost argue it's been the private companies who've refused to go public because they had a very attractive market to raise capital on the private side. You could raise capital, at least until 12 months ago, relatively easily, with very little corporate governance, with no downside protection for investors, with very little structure. In many instances, it was common stock, no liquidation preference. That was a function of just a massive amount of pool of capital coming into that market from non-traditional private placement players, so mutual funds, hedge funds, family offices, sovereign wealth funds. So the traditional VC and growth equity funds who would have typically driven that market saw themselves competing with all these other pools of capital. That basically made it a very attractive market for private companies. Now, that has changed. 12 months ago, there was a big correction in that market. I think we're seeing that reverse. Investors are much more carrying out with much more scrutiny the level of diligence they do. They're asking for much more downside protection and, importantly, for a certain amount of corporate governance. This is just segmentation of the various private companies out there above $1 billion. It's a very large number. A lot of these will have to come to market. So you can assume that 17, 18, and 19 will be very active markets when it comes to the IPO space as these companies look for liquidity and additional capital raise. This just gives you a sense for how, on a quarterly basis, volumes have developed over time in the private capital markets. It's a global stat. What I think is most interesting is if you look at how, over the last 7 years, it's shifted from being a very US-centric market, just reflecting where most of the entrepreneurship and the innovation was coming through, to now being majority outside the US, particularly Asia taking stage, mostly driven by China. And right now, over, I think it's, 60%, as of 2016, of the capital being raised privately globally is actually being raised for companies based in Asia, predominantly in China. One of the reasons why there was that big correction in the private capital markets is there was a big dislocation between the valuations that were being achieved in private markets versus public markets. And what happened was a lot of these mutual funds and hedge funds who were playing in the private markets started to realize they had to mark their investments, even if they were in illiquid securities in private companies. And that meant a number of very publicly commented markdowns in some of the big investors' portfolios, be it Fidelity, be it T. Rowe Price or Morgan Stanley Investment Management, around a number of very notable private investments they had done that when marked to reality of where public markets were trading meant they were significantly underwater. And that really made investors take a step back and drove that correction we saw until the end of last year and beginning of this year. I was mentioning before value concentration. This gives you the top 50 companies in terms of value based on their last funding rounds at a global scale. Again, 50% of the value, which is about $500 billion, that's $500 billion, is actually concentrated on 5 companies, 3 of which are in China, Ant Financial, DiDi, and Xiaomi. So again, same themes you see in the public markets happening in the private side, which is a lot of the value creation shifting outside the US into Asia, and hopefully we'll see more and more of that in Europe, and particularly in Southern Europe. And importantly, it being still very, very concentrated with a relatively long tail of businesses. This speaks to one thing which you've heard about previous speaker, and I think you'll hear about during this event, the ability to scale. I mean, what drives value is the ability to scale and to do so efficiently. So a lot of what you're hearing from a number of service providers who come and try and provide the right support for the ecosystem have a very important point to make, which is that ability to scale quickly and efficiently is what's ultimately going to drive value. That's when all the network effects really kick in with a limited use of capital. And that's what some of these guys who've really created a massive amount of value in a very limited number of years have benefited from. Now, just one final point on the private side of the market. That same shift from the US to non-US markets has also happened when you look at the mid-cap. So we were looking at the top 50 companies. But even if you go down and look at smaller businesses, 77% of the value currently sits outside the US. And it's much more equally balanced across Europe and Asia, notably China and Southeast Asia, with a very small presence in Latin America. Now, moving on to M&A. As a result of that slowdown in the equity markets, and particularly around the IPO product, we've seen a very significant increase in the technology space around the M&A product. And basically, companies who were not able to raise capital in the private markets and or go public, looking for capital and or a partner and monetizing value created in the M&A markets. Last year was a record year. It was even higher volumes than what we saw during the last tech bubble back in 99 and 2000. This year will probably not be as high, but it's still going to be probably the second largest year in history in terms of M&A volumes in technology. This has an important implication when you kind of link M&A and IPO, which is that amount of M&A volumes is taking a lot of capital out of the public markets. And you have billions and billions of dollars being returned to investors. So they're accumulating a huge amount of liquidity, which they need to put to play. It's burning their pockets. In a negative interest rate environment, they need to put that money to play. To give you some sense, over the last 2 years, on average, the net outflows in terms of how much investors are putting to play in the technology space versus how much is coming back to them because of M&A is about $30 billion a year, which in aggregate over the last 2 years, actually, because it's been very back-ended, amounts to about $200 billion. So you have all these large institutions in the public markets who have just seen $200 billion come back to them over the last 2 years, and they need to put that money to play. That's fantastic news for you guys, whether it's in a private setting or in a public setting. So there's no issue around liquidity. It's more, frankly, a function of companies being ready to take that next step into the public phase, and importantly, be comfortable with the sort of valuations that currently the market is allowing for. There has been an adjustment in sort of multiples that markets or investors are willing to pay for growth, and you need to just kind of get comfortable with that. If we look at how valuation levels have evolved, over time, that's over the last 4 or 5 years, you see them from an M&A perspective peaking around 2012, 2013, very similar to what we saw with the IPO market. There's a very high correlation between the two markets. The way we're looking at this is just, again, looking at next 12 months revenue multiples, just as a proxy for the industry. And particularly if you look at the software space, it went as high as 18, 20 times. Some of the very disruptive cloud, SaaS-type businesses out there, particularly in the US, were trading up until 18, 20 times, the likes of Workday and a couple other guys of similar profile. That has come down materially, and it gives you a sense for how much valuations have adjusted. Those same companies are now trading, in the best of cases, around 10 times, maybe 11 times. Some of the recent deals, we've seen a little bit of a spike in the valuation levels, and we've gone down as on average around 5 times, and it's gone up again 6.5 times. So it's fluctuating quite a lot. That decline in valuation levels has obviously in the M&A market also influenced how people were thinking about going public. Now, in terms of some of the key themes driving that massive amount of M&A, and if you're trying to think, okay, who am I going to sell my business to? You always have the strategics, the obvious players who operate in the same space as you do and who may have synergies and some industrial logic to buying your business. We've seen, however, a couple of different drivers of this level of activity which are new. One is private equity players. These are financial sponsors, the likes of an Apax, a CVC, a Blackstone, a Bain. These are traditionally perceived not to play in a very big way in the technology space. Why? Because they were typically would put money to play with a very leveraged thesis. They would basically rely to a great extent in their value creation on the use of debt and that being paid down and that driving earnings accretion. That, particularly post the financial crisis, has really hit a bit of a wall, and they've had to reinvent themselves. And they've really shifted radically in the way they approach investments, to the point that now, if you look at these 7 deals, these are all in the last 3 months, consistently we've seen sponsors beating strategics in auction-type processes, buying very sizable and to a great degree expensive businesses. And so in any one of these processes, you would have had someone like SAP, like Oracle, like Microsoft, like Salesforce.com, looking at buying these businesses. These are predominantly cloud, SaaS-type businesses in the US. And the sponsors just came through. They were the winners out of the auction. They paid very meaningful premiums. They were all public companies, in some cases 60, 70% premium to the trading price. So it's a very important phenomenon. I think we're going to see this play out not just in software, where it's a little bit easier for them just because of the predictability and the sustainability of the revenue stream, but also I think moving into consumer internet is likely going to happen as well, as long as a certain amount of profitability is well proven. And as I was saying, the paradigm is how do they look at investments has changed. And now it's no longer about leverage, it's no longer about cost cutting. It's about believing in driving growth, top line growth. And it's about looking at their investments not on an EBITDA multiple, but on a revenue multiple. Yes, of course, you need to look at how that plays out over time, how the profitability ramps up, but they're much more constructive in terms of how they think about valuation by looking at companies' future value creation based on top-line growth as opposed to just cutting costs. The other big theme I really want to point out to everyone is China. The amount of M&A activity outbound from China is growing exponentially. If you look at that on the left-hand side, that chart, it's been almost inexistent until last year. It's really exploded in the last 12 months, and it's going to continue to grow at an incredible pace. You have some very interesting dynamics where Chinese companies, particularly if they're listed in the A-share market, which is the mainland market in China, not Hong Kong, they typically, because of a big imbalance between supply and demand, trade at very high multiples. You see companies trading 150, 200 times earnings. That provides for what I think is unsustainable, but today real arbitrage opportunity from a valuation perspective. They can buy businesses in the Western world which trade at, let's call them normal levels, 10, 15, 20, 30 times PE, and they can bring them back into China, finance them through equity, which they raise at 200 times PE. There's a massive immediate value creation opportunity. It's not sustainable, but right now it's driving a massive amount of M&A. As a result, the types of buyers you're going to face are going to be companies which are either logical, i.e. players who are strategic in nature, who operate in the same space, who you would expect, i.e. if you're selling an e-commerce business, maybe Alibaba cares, maybe JD.com cares. If you're selling a gaming business, as we did when we sold Supercell earlier this year, Tencent would care, and they bought it. But you also see a number of businesses which come from a very different background, who have no strong logic to the asset they're buying. They're typically industrial groups who are looking to diversify their revenue stream, who are looking to do the valuation arbitrage, and who in some cases, and this is very particular to the Chinese market, have actually committed to the market a certain level of earnings. And they're not going to deliver it through organic growth. They effectively go outside China and buy those earnings. So it's creating I think it's going to create a bit of a bubble as a result, because they are willing to pay higher valuations than what you typically see in the Western world when we're running these auctions. But reality is the buyers are there and they're very, very active. It's got its challenges. They need to go through a whole number of approvals internally in China from different bodies. It's a bit of a black box, so anticipating how that plays out has its execution risk. And to the extent the business you're selling has a strong US connection to it, you typically run into CFIUS issues, which is basically the main organism in the US that controls foreign ownership of what are perceived to be strategic assets to the US. But watch that space. It's a very interesting dynamic what's happening with China. A word maybe on the big tech giants. They're sitting on over $600 billion of cash, and that's about 12 companies only. They've been incredibly disciplined. It doesn't mean they're just buying front, left, and center with no criteria. They actually have proven to be very, very disciplined. But we're starting to see a bit more of activity coming out of these guys and putting that money to play. There's an ongoing debate because a lot of this cash is offshore. That is mainly because there's some tax impact if they repatriate that to the US. That's a big theme actually as part of the US elections debate. So depending on how that plays out, this picture may change or not. But to the extent it doesn't, I think we'll continue to see some of these guys be more and more on the front foot trying to put that cash to play because it's continuing to accumulate. And again, in negative interest rate environment, it's not sustainable. The most meaningful, maybe and sizable deal as of the last 3 months was Microsoft buying LinkedIn for $26 billion. In terms of which verticals are seeing a lot of this M&A activity, cloud is, software within software. The cloud business clearly has been a significant increase in the levels of activity. A couple of deals in the preceding 2 years. We've seen 11 deals so far in 2016, and this is just an acknowledgement, both by strategics but also by financial investors who are looking at what's going to create value going forward, that the cloud model, the SaaS type model in delivering products and services, particularly from a software perspective, is really the winning model. And it is allowing to increase TAMs, it is allowing to address a much larger population from a client universe and do it much more effectively. The other important theme that kind of reading between the lines, if you look at some of the companies being sold, is the focus by verticals. So there's a theory developing that companies which are particularly focused in one vertical, in one industry, will have a competitive advantage because the ROI they get on their marketing spend, on their products, on their capabilities, is enhanced by virtue of not having to serve horizontally a number of industries which typically have a number of structural differences from each one from another. Talking about verticals, I mean, the other big space we're starting to see a lot of activity and which drives non-traditional tech buyers into the industry is Internet of Things. Now, Internet of Things is used very easily and it can mean very many things and it touches many, many different industries. But as a general theme, it's clearly driving a fair amount of M&A. And what's happening is particularly the big industrial groups who have a foot into the automotive sector or the industrial sector or some of the other areas in your home where Internet of Things is going to play a very important role, that is driving a strong appetite on their side to drive M&A. And we've seen them quite aggressively buying predominantly software or in some cases hardware-based businesses, which allow them to build on their existing footprint, on their existing client base and capabilities, but bring this added value, which is going to be driving a lot of, particularly from a consumer perspective, adoption of new solutions. So that's another big trend behind M&A. Maybe a final point just on size. No deal is too large. We've seen recently $30, $40, $50 billion deals getting done. The financing is there. It's always a combination of debt and equity. The risk appetite among the management teams around these big strategics is also there to embark on very large transactions. And so I think we will continue to see a number of big deals. 7 of the 11 largest tech deals of the last 10, 15 years have happened in the last 18 months. And it does definitely feel like that's going to be a trend which will continue into 2017. So to wrap it up and even just a couple of minutes for questions, a couple of relevant takeaways for the group. From an M&A perspective, just tactically, I think the old model where a company would decide we want to find for a new partner, a new buyer, let's run a process, let's find who's interested, that doesn't really work that well because in many instances, the number of strategic players who may be interested may be small, and they may have other priorities. And whilst it may have strong logic for them to buy you, they may not have you as a top priority. So socializing with them in advance, spending time in creating the awareness around your business, around what you're doing, in a non-transactional setting is a great way to create that awareness. And it makes it so much easier that when you do want to embark more seriously on a process and look for a buyer for your business, you've got a lot of ground covered. And we've seen that play out. You can do it in a very risk-controlled way in the sense of not creating any expectation that you're for sale. Just truly doing it by virtue of wanting to connect, create your network. There's always good commercial reasons, typically, for you to be talking to some of the other players in the industry. So that is a formula which we think works very well. On the equity side, the question we inevitably get in Europe from a company going public is, where do we go public? US versus Europe. And it's true that until 3-4 years ago, going public for a high-growth tech business which was loss-making was incredibly challenging. You could only really get that done in the US, whether it's NASDAQ or NYSE, it didn't really matter. That has changed dramatically. You have now a very receptive European capital markets where IPOs of tech companies can get done and can get done at the same sort of valuation levels as we would achieve in the US. There really is no arbitrage. Remember, the investor base is global. So to pick on the last, we just took public a company in the Holland called Takeaway.com. It's like La Nevera Roja or Just Eat, takeaway, your food delivery business. It was listed in Holland, in Amsterdam. The investor base was global. The roadshow was global. We spent time seeing investors in Europe and in the US. They probably had 35% of the orders of the book and the allocation of shares went to US investors. And there was no meaningful difference in how US versus European investors looked at it. The investors technically don't care from a listing venue perspective. There is a small portion of investors in the US who can only invest in the US, in US listed securities, but it's a small portion. You don't really lose much of the demand by going in Europe. You've got the right amount of equity research support, specialized. You've got specialist salespeople with banks like Morgan Stanley who now only trade in internet stocks. So the ecosystem has really developed to provide for a very good platform for companies to go public in Europe. It's not just about growth. Profitability really matters, particularly at a point in time where you're going public. Maybe less so in the early stage. I think in the early stage we would all still agree you need to favor growth and really cement a competitive positioning and the leadership. But over time, as you look at realizing value and going public, profitability really kicks in as an important driver. And lastly, I think scale is very important. Liquidity levels in the markets have come down. And so equity investors, when looking at an IPO, really care about what's the free float, what's the amount of liquidity they're going to have to be able to trade in and out of a stock. And something below $300-400 million in terms of free float starts putting people off. And you start losing a lot of investors who just are not comfortable they've got enough liquidity once the stock starts trading. So that's quite important. And just one final observation, just generally, focus seems to drive value or a premium valuation. I made the comment earlier, why hasn't Amazon succeeded in apparel? Because we as consumers want to go to a Van Privé or a Privalia or a Zalando to buy our apparel. We don't want to go to Amazon. Some industries, some verticals require focus. The consumer wants a particular user experience. The brand plays a role. And so that applies in most verticals. I think the horizontal play, by and large, doesn't work as well. With that, let me stop there. I think I've got about a minute for any questions, and thank you for your attention. Please.
Hi, I'm Luis Armanguet from Oxocorp Database. I want to know, you spoke before about Chinese M&A transactions. Chinese used to be doing a lot of bargain hunting in Europe. Now it seems that they're paying much more.
Yeah.
Do they really adjust to the rules set up by investment banks in auctions?
Yes.
Or do they try to stretch a lot and make transactions much longer and try to weaken the seller?
We've seen them move quickly. They're not very experienced, so depending on if you're talking to someone like Tencent or Alibaba, they're very experienced. Their management teams predominantly are actually ex-bankers or at least Western in their educations. So they know how the game works. There are more inexperienced players out there, but they run pretty quickly. You just need to stay on top of them more. You need to anticipate they're not going to be doing certain things you would expect them to, but they do adhere to the rules. The biggest challenge is trying to avoid in the transaction itself some of the issues you can't control. For example, the CSRC, which is the Chinese Stock Exchange regulator, has a limit on how much they can pay for a business, which is more or less around 20 times earnings. So if you're going to be above that, just based on your latest financials, you need to basically have a structure which is done through an SPV outside China where the funding is already offshore, so you don't need approvals for offshoring of the money, and where you don't need the CSRC approval. And that way you de-risk the transaction. But timing-wise, they do play by the rules. Yeah. Okay. Thank you, everyone, and hope you enjoy the rest of the event. Thank you.